Good morning, everybody. Hopefully you had a wonderful Thanksgiving weekend and you're ready to hit it here in the last stretch of 2017. So we got some interesting topics covered here. I think one of them in particular will help you immensely. So let's go ahead and get started. So last week's 5-minute moneymaker was talking about the fact that when what did they find out when they analyzed over 7 years? What did they find out happened when people sold stocks? Good thing or bad thing? Said, surprise, surprise, on average, the shares people sold did better than the shares they bought. And not by a little, but by a large margin. If they had held the stock that they had, they would have made 3.2% more per year. On average, stock return of 7%, that's almost 50% better if they had done nothing. And do you think that's only the individual? When they looked at it, do you think that was only individual, or was that also professional managers? It was everyone. It was both. Exactly right. So, because what happens is when things go poorly, if you look at, because I get Value Line, Morningstar, and with Value Line, when they look at timeliness, they tell you to buy when. Or when you look at, a lot of my stock portfolio is a TD Ameritrade. When you look at all of their what do you call it, the research on the one side, so they give you 5 different research companies that tell you what they think about that stock. What do most of the research companies say when the stock is down, when the stock has fallen? What do most of the research companies say when the stock has fallen? Yeah, Nicholas, they say sell. They say sell. Raymond, they should say buy. They don't. They say sell. Not all of them, but the majority of them will say sell because the stock has plummeted. No. You're saying, Raymond, that's the time to buy if it's a good, high-quality company. So, I mean, but human nature, I don't care how, and what have they found with professional managers? Will professional managers look at the stats and say, you know what, I know the stats say I should buy, or I know the stats say I should sell, but I know better than the stats? How often does that happen for professional managers? They have rules. They have the things they're going to follow, but in the end, when they look at those rules, guess what they say? Guess what they say? They come up with an argument on why those numbers don't apply to the particular thing that they want to do. Human nature, just human nature. So 5Q tape breakdown was talking about motive, and of all the things that we do in the scripts, what's the most important 10% that we do in scripts, guys? What's the most important 10% that we do in all the scripts? Ooh, nobody's answering. That's motive. Yeah, everybody's saying motive now. Good. Motive. Gotta be good at the motive. So Joe Spillman at ECA sent me this, and I thought it was pretty interesting. The Morningstar Mirage. Millions of people trust Morningstar to help them decide where to put their money, from pension funds to endowments to financial advisors to individuals. Investors rely on Morningstar star ratings to help divide $16 trillion among America's mutual funds. In much the way shoppers use Amazon's ratings to pick products. A lot of these investors and people paid to guide them take for granted the number of stars awarded the mutual fund is a good guide for performance. And by and large, it what? Isn't. The Wall Street Journal tested Morningstar's ratings by examining the performance of thousands of funds dating back to 2003, shortly after the company began its current system. Funds that earned high star ratings attracted the vast majority of investors' dollars. So, where do people put their money, guys? Where do people put their money? 5-star funds. And here's what they found. Of the funds awarded a coveted 5-star rating, only 12% did well enough over the next 5 years to earn a top rating for that period. 10% performed so poorly in the bottom, rock bottom. I remember the year I made a million working with individuals, it's very rare that I couldn't crush every single portfolio with the 21-point checklist. But I ran into this one portfolio. It's like, holy crap! They're getting more reward than risk. Holy crap! Their turnover is low. Holy crap! I mean, there was a perfect portfolio. I was like, I have never in 3 years of running probably 900 people through this process seen that happen before. Well, guess what I found out they'd done? Yeah, Mark. They went back and backward looked. They had just put them into the 5-star funds 3 months before they came to see me. So was that valid, a way to invest? No, because what have we found out about? What have we found out about uh, things that have performed well for the last 5 years? What generally happens when it comes to money management? Yeah, they drop. So the great example of that is Fairholme Fund, which for 10 years, ending November 2013, I'm just using this particular one, not because it's current, but as an example of what happens here. 10 years from 2003 to 2013, the average annual return was 11.4%. During that beat 99% of all other managers. The average equity investor only earned 5.5%. It averaged 11.4. That's almost double, almost twice the return of the market. What happened in just the next year? Trailed all the managers by 100%. How's it done since then? So, and guess when most investors put their money into that fund? They plowed $7 billion in the year before it crashed. It was an unknown fund in 2003. Nobody was putting money into it. But 2013, guess what? Hey, it's the #1 fund, so guess where I'm going to put all my money? Boom, they got killed. Now, the reason I bring that up is we're sitting in the same type of scenario right now. The same type of scenario with another type of security. What security do you think that is? No, anybody that's investing in Bitcoin is an idiot. So not a Bitcoin, Nicholas. So not ETFs. You're getting close, Raymond. Bonds, that's right. Wade, Fred, bonds. So this is 1900 to present for interest rates. So where are we on interest rates? Where are we on interest rates? How low? Yeah, how long has it been since we've seen interest rates this low? $50 years, right? 60 years. Now, there's a couple of things. So, you know, when people think this is how the world works, this is how the world works, this is how the world works, you explain to clients that, hey, stocks are going to keep you ahead of inflation. We busted that bubble, right? Because how often in the last 51 years have stocks kept clients above inflation? You know, 1/3 of the time. That means 2/3 of the time they did not keep your clients above inflation. And how many of our competitors know that? How much money would you bet if you ran into one of your competitors and you asked them that question? How much money would you bet that they'd get that question wrong? I'd bet $1 million. Now, the point I want to make that is, you know what? We used to tell people that we would not see interest rates higher than 5%, because 5%, we hadn't seen 5% all the way back to 1868. So that means for 100 years, we'd never seen interest rates higher than 5%. So when advisors told their clients, hey, we'll never see interest rates higher than 5%, because for 100 years it hasn't been higher than 5%, what happened to that promise? What happened to that promise in the 70s? Yeah, by a little or by a lot? By a lot. So we can't make promises. Stocks are always going to keep you ahead of inflation. We found that that's a big fallacy. Interest rates are going to be this or that. That's a big fallacy. But when it comes to interest rates, how much room do we have to go lower? Do you think most people would be surprised by this chart? Is this a good chart to show people? And when it comes to if they've got bonds in their portfolio, is this a good chart to show people? Because we ask them questions, but this is what? A picture paints 1,000 words. Now here's why that's important. Most of our clients' monies are in bond funds, because you know when you're buying individual, if your client's buying bonds of 5,000 or 10,000 or 25,000, what can you guarantee them? If you have a client that's buying bonds at 5,000, 10,000, or $25,000 sizes, what can you guarantee them? The fees are killing them, right, Nicholas? The fees are killing them. The reason, the reason being is they're buying when you buy a bond that small, guess how much? And it's not necessarily the fees, but you're right, Nicholas. I know that what your point is fees. It's the markup that's killing them. And guys, I used to sell bonds at the bank, and guess how much money you could make on bonds as an advisor? Guess how much money you can make on bonds? Tons. Because you tell them, you'd sell them a bond that was maybe yielding 3%. 3%. And you could, and if CDs were at 1.5%, guess what you could do? Yeah, 3 or 4% markup, right, Dave? And that's for the thing about the 3 or 4% markup. That's the commission. That's what you would make. The thing about it is, was that a one-time thing, or did that bond mature again then 3, 4, 5 years from now? It matured 3, 4, 5 years from now, so then I could make 3 or 4% over. Guess how much I could make over a 10-year time period? So you could make a ton of money selling bonds. So if our clients are buying $5,000, $10,000, $25,000, they're getting screwed on the markup. They are getting taken advantage of. So what a lot of people buy is bond funds. So I don't know if you've looked at the bond funds or how we handle them, but I want you to understand how we handle them. So, and we're actually going to take this down, this audio right here, 2 minutes, 41 seconds, and we're going to actually put up what I'm about to go through when we're done with this call. So how do they stack up, bonds versus bond funds? There's all sorts of differences. Which one of these differences is the biggest one that the client should worry about? What do you think the one that the client should worry about? Income payment frequency, purchase management, diversification, cost, maturity, credit risk, liquidity. Which one? A lot of guys, Wade's got it, Dave's got it, Nicholas has got it. No, not cost. Till's got it. So good. We got 3, 4 people have it right. It's the maturity. Why is maturity a problem for people who have bonds? Without maturity, what do you not have? Without maturity, what do you not have with bonds? Safety, return of principal, exactly right, the guarantee, principal protection. Because with a bond, at least if you hold it to maturity and they don't default, what are you going to get back? Your principal. Are you ever guaranteed of getting your principal back on a bond fund? So people that bought bonds back in 1990 or 2000, hey, that's awesome, because what did they do? As interest rates are going down, what happened to them? They're making money. It's awesome. So guess what people who bought bonds think, how bonds work? There's no risk. Bond funds, there's no risk of bond funds. You make a ton of money. It's awesome. Is that the way? Yeah, it did work that way for the last 10, 15 years. What are we at now, though, guys? What's happening now? What's the only direction interest rates can go? What's the only direction what's the only direction interest rate? Yeah, exactly. Everybody's saying up. Yep, good. So if interest rates go up and there's no maturity, that means as the bond values go down, what's going to happen to these people? Will they ever get their money back? So if you've got people in bonds right now, bond funds, or $5, $10, $25,000 bonds, what are these people getting? Yeah, false hope, screwed. They don't get what they have. So how do we deal with that? Because a bond fund is a lot different than a bond. And this is from the movie Red, Retired Extremely Dangerous. But I say, you know what? Bond funds are extremely dangerous for the retired. Why? Why are bond funds extremely dangerous for the retired? Because they think they have what, and they don't have that. In fact, they have the complete opposite. They think they have safety, but they have the complete opposite. It's dangerous. So how do we deal with bond funds? So the first thing you always have to do is you go through the interest rate volatility script, because it's still a bond. It acts like a bond. They have to understand, what's the purpose of the bond interest rate volatility script? What's the purpose of that script? Yes, Dave. So they understand how interest rates affect, number one, they understand how interest rates affect their values. Second of all, that they understand how what affects their values. Interest rates affect the values. What else affects the values? Maturity, yeah, the length. The length. So if somebody has a individual bond that has 5 years or less maturity, guess what I tell them to do? They have a bond with 5 years. Yeah, keep it. Hold it. Keep it. But then I tell them if you have between 5 and 10 years, that's kind of in the gray area. But anything above 10 years, you need to what? Run, exactly. Get out of it. Now, here's the thing. When you look at bond funds, does Morningstar tell you? No, back to Morningstar. Do we ever use Morningstar when Jeff runs the Morningstars with the 21-point checklist? Do we ever point out the star value of the Morningstar? Is that why we use the Morningstar? In fact, we use Morningstar almost the opposite of what every other advisor uses Morningstar. We don't use Morningstar to show people, tell people what they should invest in. Instead, we have them understand what it is they currently have. So, first thing you need to do is they have to understand how interest rates and how maturity affect their bonds, okay? So now well, let's assume that I've done that with Jeff. So Jeff understands that as interest rates go up, bonds go down, and they go down how much, guys? As interest rates go up, bonds go down, and go down how much? Well, if you've done yeah, that's right, Mark. So if you've done the script and you understand the script, just a 1% increase in interest rates can cause what? 33% loss. 1% increase, and is it beyond the realm of expectations that we can see a 1% increase in interest rates soon? Is that beyond the realm of expectations? And guys, I've experienced at the bank when I sold bonds, I had people lose 40% in their bonds. Man, talk about people who are pissed off. Because do people think that bonds can lose money? No. And do people mistake bonds from CDs? Do they think bonds act like CDs? Yes, they think that what? Yeah, I might have to take a little 1 or 2% cut, but do they expect to get hit with the 30% cut if they need to sell their bonds? A 40% cut if they need to sell bonds? So, and it's not a very comfortable. And guys, you know why? Why are advisors so comfortable selling bonds right now? Why are advisors so comfortable selling bonds right now? Have they had to have that conversation with people? See, guess when I saw my clients. Guess when I had to have a discussion with my clients that their bonds lost 40% of value right here, right in the mid-90s, when they had that spike in interest rates. And I had client after client come in. They were pissed off because on their statement it said their bonds were valued 30-40% less. And how much did interest rates go up? Huge amount or little? So the first thing we're going to do is they have to understand interest rates affect and how they affect it. So then I'm going to circle back. So Jeff, again, how do interest rates affect your bond values?
Well, if interest rates go up, the bond values are going to go down.
Right, and by a little or a lot?
Well, by a lot.
By a lot. And the longer the maturity, the more they what?
Well, the more they fall.
Right. But the reason you bought bonds is why?
Well, we're not going to sell them. I mean,
right.
we're buy and hold.
Buy and hold, right? So if you hold them till the end, who cares if they're down 30% now? Because at the end, what will they pay you?
Oh, we'll still get our principal back.
Right.
Plus interest.
Right. So the reason you bought bonds is you're getting interest, and they're what if you hold them to maturity?
No, they're safe.
They're safe, yeah. So if and that's why we buy them. Because if we wanted it something that we could, if you hold a stock to maturity, or is there any such thing as a stock to maturity?
No, not that I'm aware of, no.
So we did find out that bonds could lose as much as stocks or could not lose as much as stocks.
Oh, they could.
Temporarily.
Temporarily, yeah, they could.
But if you hold to maturity, what happens?
Well, and you still get your money back.
You still get your money back. So in the end, is it a good place if you want guaranteed assets, as long as you're willing to hold a maturity?
Yeah.
Yeah, it is. And so now you're in bond funds. Now what makes up a bond fund? Are there just one bond in there, or are there like hundreds of bonds in there?
Oh, no, there's lots. There's lots of different bonds.
Yeah, there's lots of different bonds. And do you own all those bonds, or you and a bunch of other investors own all those bonds?
No, it's a bunch of people. It's a fund that a bunch of people own all the bonds.
Yeah, so like you said, there's a bunch of bonds and a bunch of people who what?
Who own them?
Who own them, yeah. Now, would you consider yourself, I think you're a smart investor, but what would you think? You think you're a smart or a dumb investor?
I mean, I consider myself above average.
Well, I certainly do too, because what did you say about bonds? We pointed out that if interest rates go up, bonds are going to what?
Go down.
And then you pointed out that what? Yeah, but they're not going to go down if I what?
Not if you hold them to maturity.
Yeah, and would you be dumb enough to get out if the bond was down 30, 40%?
No.
Because you're a what? Dumb or smart investor?
No, we're smart.
You're a smart investor. So do you think all investors are smart?
No, I don't think, not all, no.
No. In fact, what have we found out in history? Most individual investors are smart, or maybe most could use a little bit more intestinal fortitude or a little help doing the right thing instead of the wrong thing, getting out at the wrong time, getting in at the wrong time.
Yeah, most people get out at the wrong time.
But you are what?
Well, we're long term. We pretty much just kind of set it and forget it.
Set it and forget it, yeah, exactly. So do you think some people, like you said, hey, I'm just going to hold to the end. My bond goes down 30%, guess what I'm going to do?
Just keep it.
Keep it. Hold it till what?
Just hold it till it matures.
Hold it till maturity. Yeah. Do you think that some people, though, do you think would, if their bond went down 5%, would say, holy cow, I thought this was supposed to be guaranteed, and they would go ahead and get rid of that bond? Would some people panic?
Yeah, some people would.
Yeah. And if they panic, they're going to sell that bond. Now, what do we say? How do bond funds work again? They're just one bond or lots of bonds?
No, it's lots.
One investor or lots of investors?
Lots of investors.
So some of those investors panic when the fund goes down 5% because interest rates went up. Because what would happen to the bond fund if interest rates went up? All these bonds would what?
Oh, it'd go down. It would
go down. Yeah. So these people that panic when the fund goes down 5%, what can the money manager that's managing the bond fund say? I'm not going to give you your money, or what do they have to do?
No, you have to give them their money.
So what do they have to do to raise that money to give those people that panicked at 5%?
They're probably going to sell the bonds, I guess.
Oh, so what just happened to those bonds? Were they allowed to mature, or they had to sell at a loss?
No, they had to sell at a loss.
And then you think some people said, I'm not going to sell at 5, but when they gets to 8% down, they say, holy crap, that's too much, I'm out.
Yeah. There's going to be more people at 8 than 5.
And then so when they ask for their money, what does a fund manager have to do?
Just give it to them.
Can you say, I don't want to, you're selling at a loss, and I don't want to hurt all the other people staying in the fund, or what's he have to do?
No, he has to give them their money.
Has to give them their money. So when they sell that, then what happens to the bond prices?
Oh, they go down.
And now some people say 8% is okay, but 10, I'm out now. So what's the bond fund manager have to do?
Sell more bonds.
Locking in more what?
More losses.
And when more, is it only this bond fund or all the bond funds that are doing this now?
No, it's all the bond funds.
So when everybody sells at 10%, what's it going to cause bond values to do?
Drop even further.
And some people say not 10, but at 12. What's starting to happen? Every time everybody has the same threshold of pain or a different threshold of pain?
No, everybody has a different.
But every time we reach a threshold, what do those people do?
Oh, they sell.
Which causes us to lock in what?
Losses.
And causes the bonds to continue to what?
Fall.
So you're being smart by holding to maturity, but are you being helped by the dummies that are getting out, or hurt for being smart?
No, we're being hurt.
Because we have this kind of death spiral going on, right?
Right.
So as the dumb people get out, what happens to smart people like you?
Oh, you get shafted.
Yeah, so now you're being rewarded for being smart, or you're being punished for being smart with the bond fund?
No, we're being punished.
Because this death spiral continues down, 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 and if you hold on to the end, all of those bonds that they had to sold locked in what?
Oh, losses.
And who ends up getting to experience all those losses? The smart people or the dumb people?
The smart people end up taking all the losses.
Yeah. And will they ever see that back if they were sold at losses?
No, maybe not, no.
Maybe not, or they won't, because once they sell them at a loss, guess what's happened?
It's locked in. It's lost.
So there's smart, and then there's smart. So this, do we ever get? You ever heard no good deed goes unpunished?
Yeah,
In this case, no smart investor goes what?
unpunished.
Because you can be the smartest investor in the world, but all the dummies are going to cause what to happen to you?
We're still going to end up losing money.
Yeah, a little or a lot.
A lot.
And it will come back or it's locked in.
No, it's locked in at that point.
So there's smart, and then there's smart. So smart is writing that down, locking in the losses, and being punished by the dummies. And then there's smart. What's that smart? The guy that gets out what?
Before all that happens.
Before all that happens. The guy who knows how bonds are going to work and how bond what are going to work.
Well, bond funds.
So are bond funds any place for somebody that wants to guarantee their money, wants a safe place for their money at this particular time period?
No, not if you want to guarantee, no.
No, why? Because at first we thought bonds gave us guarantees, and they do if they're what? In bond funds or individual bonds?
Individual bonds.
And you're in what?
Well, we're in bond funds.
Yeah. So that means we should be doing what at this point?
Well, we should be looking to leave.
How quickly?
That's tomorrow.
Tomorrow. Now, why would this be? Now we're going to talk about the motive. I'm going to go into the motive because we got him to what? Want to get out of bonds. Is that the only thing we want to do? Could Jeff go back to his current advisor and say, "Get me the heck out of these bond funds"? Could he do that? So can we stop there? No. So I'm going to say. So now let's. You can do this with if they're do-it-yourselfers. You can go after Fidelity or TDA or whatever. If they're with advisor, you can go after them. But you can say. So can I ask you a question, Jeff?
Yeah.
Had you ever heard that what you have is actually as risky as stocks, or that they're safe, a good place to put your guaranteed money?
Well, I'd heard they're safe.
Yeah, and instead, what do we find out?
Well, they're risky.
They're risky. So were you ever told that?
No, we weren't.
So do you think only you and I know how bonds and bond funds work, that you'd be guaranteeing to lock in your losses as people bail when interest rates go up? Or do you think companies understand that and advisors don't understand that?
Well, I would imagine advisors would understand that at the very least.
Yeah, and how about the companies that they sell?
Oh, yeah, definitely.
Like you're in Vanguard bond funds. Do you think that the Vanguard understands that? Are they dumb?
No.
A dumb investment company or a smart investment company?
No, they're smart.
They're smart. So do you think all the investors out there understand what we just went through? Do you think all the investors understand how bond funds work?
No, I doubt
few?
it. No, very few.
Well, you know how we know that for sure? What
How's
would be
that?
happening to bond funds right now if everybody knew that's how they work?
Everybody would be leaving.
They'd be leaving. Now, what would happen to the bond funds if everybody was leaving?
They'd go down.
Not only would they go down, but if everybody's selling all the bonds in that fund, what happens to the fund?
Goes away.
Does Vanguard, or in your case, or Fidelity, or any of the other bond funds want that to happen?
No, they don't.
Why not?
Well, because then they don't make any money on them.
Yeah, because people would say, maybe if I want guaranteed money, where should I put it?
CDs or the bank
Yeah.
or something like that.
And then Fidelity and Vanguard would be out what?
They'd be out all that money.
They'd be out all that money. So why do you think the companies don't tell you about this?
Oh, they want you to buy their fund.
They want you to buy their fund. So then how do you think they get advisors to, quote unquote, forget to tell people about how bond funds work, and to tell people, hey, we've got your growth money in stocks, but we're going to put your safe money in bonds? Why do they forget to tell people that the bond funds aren't actually safe? How do the funds get the advisors to forget to tell people about this?
Probably pay them more.
So why do you think that this happened to you? That you thought you had a good, you got growth money. The growth money is doing terrific, but this safe money here, we found out is safe or not safe?
It's not safe.
By a little or by a lot?
By a lot.
And you're being punished for being smart, or being hurt for being smart? I'm sorry, being helped for being smart. Punished or helped?
Punished for being smart.
Yeah, and this wasn't told to you why. Who didn't want you to know about this?
the company, the advisors. They wanted us to buy them.
Yeah, because if you move that guaranteed money someplace safe, what would happen to them?
Well, they wouldn't make any money.
So guys, is that how you cover bond funds presently? Good. So if you do it this way, how many people want to keep their bond funds? Who would want to keep their bond funds at this point? So do we want to just stop with the fact that they don't like bond funds? No, we have to get them to say what? This was done on purpose. Make sense? Now, as a little aside, they found out that, what do you think happens to hospitals when the stock market goes down? Or the bond market goes down? They found out that for every 1.5% drop in equities, hospital visits increase by 0.25%. So if the market falls 6%, what happens? Hospital visits go up by a full percentage point. You can imagine what happens when it goes down 20, 30, 40%. That's based on 3 decades of daily admission records. So what's the major cause? Mental conditions. Dave says buy hospital stocks now. So back about a month or two ago, we covered what is the most valuable asset. What's the most valuable asset that you have in your portfolio? What's the most valuable asset you have in your client's portfolio? The FIA. Why? Well, first of all, record numbers. This is a quick review. Record numbers, and I'm going to get to why it's important here in a second. Record number of FIAs have been sold over the last 2 years, over $32 billion a year. So why are they a good place for clients' money? It depends on who you ask. So using actual market returns versus the FIA, and this is the Society of Financial Professionals done by the Wharton School of Business, what did they find out about FIA returns versus the actual market over the last 15 years? Vanderbilt, Marion, and Babel. From 1997 to 2010, that's 13 years, what did they find out about FIAs? 67% of the time, FIAs beat the market. Oh, and by the way, how many advisors beat the market? How many money managers beat the market over that 13 years? Virtually none. So that means FIAs beat how many money managers? Yeah, well, I'll go with 5%. So how badly did FIAs beat money managers? And that's actual. That's what people actually experienced. That's what people actually experienced. So when they went and looked at the simulated, back testing, Monte Carlo, crediting methods, option, they actually figured out what would the crediting method be, what would the option prices be at that particular time, what would the spreads be, interest rates. They putting all of that in, what they found is that the point-to-point S&P 500 would have outperformed the S&P 500 15% of the time, but the S&P 500 would have outperformed 85% of the time. Of course, during those 13 years, how did that help people? Those 13 years, did that help people? And here's what do you think they're not looking at with this? So how come for 13 years, basically FIAs killed the market, but it says here the market outperformed the S&P 500 85% of the time. What is this not talking about? Or why would this seem like, well, geez, it seems like the market's the place to be? What's it not talking about? Ah, you got it, Dave. It's missing 2008, 2000, 2002. It's missing all the down markets. So this is saying any particular year, the S&P will outperform the point-to-point. But when you add in the years that the S&P 500 crashes and the point-to-point does not lose money, guess what happens to it during longer periods of time? The S&P 500 loses its power against the point-to-point over periods of time. When you go out to 5 years, 10 years, 15 years, when there's been down markets, guess what happens to this number, this S&P 500 versus the point-to-point? It falls. So any particular year, yeah, what do we say? The market goes up more often than what? Not. The market goes up more often than not. It goes up 85% of the time. It goes up. But if you add in the years that it goes down what? A little or a lot? The S&P 500, when it goes down a little or it goes down a lot? It goes down a lot. When you add that back in, all of a sudden, guess what starts to happen? As we saw from 2000 or 1997 to 2010, guess what? 67% of the time, or 67% of FIAs beat the market because of those down years. Does that make sense? So the reason I think the FIA is the most important part, well, first of all, so when we're looking at a client's guaranteed money, where should they, if this is how the guaranteed money performed against the S&P 500, where should your client's guaranteed money be? In bonds or an FIA? If I went through this explanation with, if your clients were on the call right now and you have them in bonds, guess what just happened to your client? If they were on this call right now, what just happened, and you have them in bonds, what would have happened to your client? Yeah, they'd be not too happy. Not too happy. Okay? So I think the FI is the most valuable part of your portfolio because it's guaranteed, it performs well. Now, do we ever tell clients that the reason we're investing in FIAs is to beat the market? Do we ever tell clients that? It does, but do we ever tell them that? No. We just say what? This is where your what kind of money should be. Your safe money should be. Because it's really what? As compared to bonds, it really is safe. Bonds are not safe. This is safe. The icing on the cake, though, is what? Not only are they in something place safe, but they can actually what? See market-like returns when you add in the years that the market falls and it does not, the resets. That's what. So that's why we recommend the 50-50. It also does this. Remember earlier we started out and talking about the people would sell stocks and then replace them with something else? What does the FIA, 50% of the FIA, what does that allow your clients to do? Have the intestinal fortitude to hang on, to stay in the market in their money management accounts. If they're in stocks and bonds and interest rates go up and stocks go down, and when interest rates go up, are stocks going to go up or go down? If interest rates go up, are stocks going to go up or go down? They're going to go down. And what else is going to go down? Their bonds. Terrific. How that diversification of stocks and bonds work for them? How'd that diversification of stocks and bonds? Interest rates went up, stocks go down, and bonds go down. Great, terrific. Guess what you're going to lose as a money manager then? If that's where you have your clients' monies. You're going to lose AUM two different ways because your accounts are going down, and what else is going down? The number of clients you have. So having a 50-50, the reason I think the FI is the most important investment you have is it allows, it's the cement that keeps clients with you. It's the cement that keeps clients happy even if the market's down. And it keeps them happy when the markets are up. So we ask clients this one question. It's the fifth question we ask them when they're investing. Do you want to be ready for when the market goes up, when the market goes down, or both? What is the only investment you can tell them is going to be the right place to be for both when markets are up and the markets are down? What's the only investment you can tell them when the markets are up or down, it's the best place to be? Come on, I only got 5 answers. So everybody better be writing FIAs to this. So now I got about 10. Keep going, guys. So do you get why? And again, do I tell you you need to sell your clients 50-50? Yes, I do. But if you came back, so Jeff, if you listened to a tape where the client said they wanted 100% of their money in the market and the guy did the script right, what will we say, Jeff?
Well, then put 100% of their money in the market.
Yeah. But if you say, I did the script, they wanted all their money in the market, but you don't have a tape, guess what I know? Because we've got 60,000 tapes we've listened to, 50,000 tapes archived, that when you do the tape right, guess how many of those 60,000 people, and we got proof of 50,000 of them, How many of them, when you did the tape right, wanted more than 50% of the money in the market, do you think? Out of 50,000? None. Zero. Not one single person wanted more than 50% of the money in the market. Not one out of 50,000. Guys, you'd think at least one. Not one. Why? When you do the script right, guess what? They realize, I'm not looking for, because what will people do with more money? Buy another house? Buy a bigger car? Go to a fancier vacation? No, they live the same lives. They just want to make sure what they have now does not. What are we protecting, guys? We're not protecting people's monies. What are we protecting? Lifestyle, right? Lifestyle, lifestyle, lifestyle. So the FI is what gives you the best split, the banana split. Because even though 50% of your money is guaranteed, are they being hurt on return on the guarantee? No, they're not. That's why it's the perfect investment for your clients. So when you've mastered the Crib Notes motive, your daily practice, those MIFT and GOTS, 5-minute money maker breakdown, that's when you're going to get. How many clients should you plan on bringing on next year? How many clients should you plan? All you want to, Dave. I think that's the perfect answer. Anyone that you want to. And what should you be doing right now for the next month to make sure that's the case? Practicing the what? The 21-point checklist and the 15-minute drills. So guys, you are setting yourself up for the best year ever next year. So, and like I said, this year we've had more people get good with the 20-point checklist than we've ever had in the 18-year history of 5Q. So I am so excited. But should you give up now and sit on your laurels, or should you get even more excited and dive in and do the 21-point checklist? Man, just nail it. Get better. Walk into January knowing that any person you get in front of, you know exactly what they're going to say. That's the power of the 21-point checklist script. 18 years ago or 20 years ago when I developed the script, I knew what your clients were going to say 20 years in the future. How powerful is that, guys? If you do it right, I know exactly what your clients are going to say. That's powerful. That is giving you superhuman powers. So you've done a great job in 2017. Let's make 2018 by far your best year ever by working harder or by doing all your hard work in December and then making it an easy 2018. Do all your hard work in December and you don't have to work in 2018 because it'll all come naturally to you, okay? So welcome back to work after the long holiday, and I hope you have a great week, and we'll talk to you all on Monday. Thanks, everybody.